we've seen a mixed bag. Dow at new highs, a major selling in the NASDAQ. So big banks in focus, certainly after all the earnings we've been seeing. Taylor Krystkowiak is with us, VP Investment Strategist, Themes ETF. Thank you for being with us. So some of your thoughts here, Taylor, on what we've been seeing with the big banks. I mean, we could say beat, double beats on all of them for the most part, but what's the real deal?
Absolutely. I feel like it's one of the more untold stories of the market in the current time frame, where we see so many headlines being dominated by the Magnificent Seven. But one of the unsung stories, I think, is the performance of these big banks, specifically the too big to fail banks, or these global systemically important banks. You just mentioned one of the big names, JP Morgan, here at home. Just to put some numbers in context, to give people a little bit more context of this story, 17th century bank like Barclays, you normally don't associate with double-digit returns. That name is up 54% year to date. And just to put, again, all of these numbers in context, those are outperforming 6 of the 7 Magnificent Seven stocks, something that was really highlighted after the sell-off last week. So in looking at this market where there are so few places for growth and people were feeling like the markets were getting very tech heavy, this is a great opportunity to diversify your growth in your portfolio towards these big banks that have really seen a lot of windfalls given the current macroeconomic environment that has inherently favored the way that they are positioned and are relatively insulated from a lot of the factors that are pressuring some of their smaller peers. And they have stood to be benefactors in this market. And again, there's a story that I think will continue to benefit them over the course of the next year and going forward for years to come, given the sort of elements that we're looking at in the market right now.
I really love that chart right there, because it's an unusual one. We don't see those names in that way in that kind of chart. So it really does tell the story. I mean, you have Mitsubishi, a Japanese bank, Barclays on top, then Meta, Google, Amazon, right? It's also today, I was listening to Bob Diamond, formerly of Barclays, the former head of Barclays, and he was talking about the 4 big banks really just, holding all the chips, and how maybe some of the others, Credit Suisse, he mentioned UBS, he mentioned, I felt like there was a bit of a divergence. He also noted the consolidation we're likely to see in the regionals. Is it all about the big banks? I mean, Barclays, you noted, has been doing really well, and I think that's notable too. What are some, if you do it name by name, what do we need to know?
Well, I think we can see it in the earnings across the board, whether it's JP Morgan just reporting its record earnings. It once again surprised, beat expectations, posted a record profit. Bank of America did the same thing. Citibank did the same thing. So you really look down the rest of the roster, there is incredible strength amongst all of these names. And when you really unpack the reasons why, there's a lot of kind of eccentric and esoteric data to unpack here, but I think it's integral to the story. Specifically, everyone keeps talking about commercial real estate and the sort of slow car crash that we've been watching unfold. Everyone seems to think that we got the good CPI read last week and we're out of the woods with inflation. The Fed's going to start cutting. But really, I think that doesn't pay proper respect to the environment that we're in right now, because the reality is the Fed hasn't cut yet. And because they delayed cutting, even when we look out 2 years, the implied policy rate is still 46 basis points higher 2 years out because they delayed cuts. Remember, markets started the year thinking that the Fed was going to cut 4 times this year. They haven't yet. And the reality is that's pushing back the timeline of those rates cuts. Meanwhile, all of this commercial real estate, specifically those loans, are going to need to get refinanced at the prevailing rates of interest right now. So when we take a look at the amounts, I mean, the notional value of the IMF just put out a great report a couple months ago about their financial stability report. There's $277 billion worth of these loans that are coming due in this next year that need to be refinanced. There was actually great reporting out of the Wall Street Journal just last night, hit the tape. Their headline was "Real Estate Meltdown Strains Even the Safest Office Bonds." So this is a really significant trend that we're seeing play out in the market right now as everyone moved from the office to work from home. The office sector down 23% over the last year. So it's really, really hammering anyone who has exposure to this commercial real estate. And the important distinction here with these big banks, these global systemically important banks, again, those banks that are too big to fail, they are inherently required to have much more conservative requirements when it comes to their capital reserve ratios. And just to put some numbers around this, they have 4 times less exposure to commercial real estate on a relative basis relative to some of these smaller peers. So when we take a look at how these big banks have fared ever since the Fed started hiking rates back in 2022, over time, when we look at how that segment of the market has done, they are up significantly over that 2-year period. So they are outperforming the NASDAQ, outperforming the S&P 500 since 2022. And that speaks, I think, to the fact that they are not only insulated from this commercial real estate fallout, but importantly, they are also stand to be beneficiaries. A lot of these big names like JP Morgan were able to stand and actually acquire troubled banks like First Republic when we saw that banking crisis back in 2023. So you put all of this together, and these names, I think, are going to be a great place to be to diversify your portfolio. To put into context, our fund, the Global Systemically Important Banks Fund, ticker symbol GSIB for those global systemically important banks, is actually now, as of today, outperforming the NASDAQ since inception, and will be an important place to diversify your portfolio exposure.
Yeah. Taylor Krystkowiak, thank you. Themes ETF. Good to see you, Taylor. Thank you so much for a look at those banks.
Thank you so much, Nicole.